Good afternoon, and welcome to Johnson Lambert's 2020 Insurance Industry GAAP Accounting and Tax Update webinar. We are excited to have you join us today as we discuss some hot topics within the insurance accounting space, and we hope you and your loved ones are staying safe and healthy during these challenging times. I'm Melanie Barthel, a principal at Johnson Lambert. Before I introduce you to our other presenters today, let's cover a few administrative items. First, a copy of today's presentation is available for download in the resources section. If you experience any technical difficulties during today's webinar, please click on the help icon. Additionally, please feel free to engage with our presenters by submitting a question in the Q&A window. We will do our best to answer as many of your questions during or at the end of today's session. We are offering CPE and CRE credits for participating in today's webinar. To receive your one CPE or CRE credit for today's session, you will need to be present for the full 50 minutes and answer at a minimum 4 of the polling questions. You will need to use the blue CPE icon here to download a copy of your CPE certificate at the conclusion of the presentation. Now, let's meet today's speakers. First, I want to welcome Matt Gravlin. Matt is a principal at Johnson Lambert and a tax service lead. Welcome, Matt.
Good afternoon, Melanie. Happy to be here.
Next, we have Josh Keene. Josh is an audit partner and a former member of the AICPA Insurance Expert Panel. Hello, Josh.
Hi, Melanie. Hello, everyone out there. Glad to be here.
And last but not least, we are joined by Josh Partlow, an audit partner and former member of the Auditing Standards Board. Good afternoon, Josh.
Good afternoon, Melanie. Great to be here today with you all.
Today, our session will include 4 separate sections. We will begin with a tax update, followed by some accounting considerations as it relates to the impact of COVID-19. We will then conclude with an update on upcoming changes to both the GAAP, accounting, and auditing standards. With that, I'm going to pass it to Matt for our tax update. Matt, I understand that there have been some changes to the net operating loss rules as a result of recent legislation introduced in response to COVID-19. Additionally, there's been some guidance introduced about the tax implications of taking a PPP loan. Can you talk us through those relevant considerations?
Certainly. Thank you, Melanie. I think anyone has a pulse on taxes has seen a lot of activity this year. There's been a significant amount of tax policy over the last few years, starting with the Tax Cuts and Jobs Act, and that was enacted in the end of 2017. And since then, the Joint Committee of Taxation has issued their Blue Book, which is their layman terms as to what some of the provisions of the TCJA meant. The IRS has issued guidance in a number of different fashions, and Congress has actually enacted new legislation, most significantly the CARES Act, and we'll talk a little bit about that today. So as Melanie alluded, the net operating losses are a piece that we wanted to highlight today. And going back to essentially the Tax Cuts and Jobs Act that was passed at the end of 2017, those provisions were effective mainly for tax years beginning in 2018. So really what they changed from a net operating loss is that corporations and life insurance companies are no longer allowed to carry net operating losses back. But they did change it so that you could carry those forward indefinitely. Along with that came an 80% limitation. So you essentially would have to limit your use of an NOL carry forward to 80% of your taxable income and would leave you with a residual 20% of taxable income. P&C insurance companies, on the other hand, were left exactly the way they were originally. So the rules did not change for them. They're allowed to carry back their NOLs for 2 years, and there's a 20-year carry forward of those NOLs that could not be carried back, and no limitation against taxable income in any given year. So fast forward to the CARES Act, the Coronavirus Aid, Relief, and Economic Securities Act was signed into law in March of 2020 this year. And really what this did is this suspended some of those provisions in the TCJA related to the net operating losses. First, losses arising in tax years beginning in 2018 through 2020 can essentially be carried back for all companies. So there is no longer a difference between a life insurance company, a regular subchapter C corporation, and a P&C insurance company for these 2 years. It also suspends the 80% limitation until tax years beginning in 2021. And it provides a 5-year carryback period. So similar to when we've had other economic downturns, they've extended the carryback period to not just the 2 years, but to 5 years. And that can be of significant value to companies experiencing operating losses. If you recall, as part of the TCJA, the tax rate went from a graduated rate with a maximum 35% to a flat 21%. So this affords companies the ability with net operating losses, which sustain taxable income in earlier years, to potentially recoup up to 35% of their taxes. So that's a positive thing for this law. So now let's look, what the TCJA did is it complicated things for those companies that were part of a mixed group or a mixed consolidated group. So what that means is if you had an insurance company that was a subchapter C company or a life insurance company, but then there was a P&C subsidiary as part of that consolidated group, it spawned the question as to which rules trump the other when it comes to applying these new net operating loss rules. So, industry, the IRS and listened to the industry and essentially came up with final regulations just last month, at the end of October. They came out and published these regulations, and it relates to the absorption of carryovers and carrybacks in a mixed group environment. It applies to tax years beginning in 2021, but these changes can be applied to prior years if it's done consistently. So if you haven't filed your returns yet and you can apply these rules consistently, you can do that. Under the TCJA, the general rule for under Section 172 relates to, and again, this is ignoring the CARES Act provisions, a two-step approach to applying net operating losses. First, you would deduct any net operating losses incurred prior to 2018 without applying any limit. Once those losses are exhausted, then you can deduct any post-2017, so any losses that you incur in 2018, 19, and forward. You would then apply the 80% limit to the use of those. The absorption of losses, so in the final regulations, the application limit depends essentially on the income-producing member. And what that requires is it requires you to break your entities into two different pools. One is the residual income pool, and essentially that's the income from the members that are non-life insurance companies, not non-life insurance companies. Those would be your C corporations and your life insurance companies. And then your second pool would be your non-life insurance income pool, and that's your P&C entities. So this essentially requires a two sub-consolidation calculation to determine the use of those NOLs. Essentially, it's more complicated. Your carry-forward schedules will need to be more comprehensive, and you'll have to track these two pools separately going forward. Essentially, this can impact the timing of your book accruals and your actual tax filings in terms of the differences that might exist between those based off the different facts when known. So let's get into an example. And again, these are fairly simple examples. The final regulations are fairly complicated, so we tried to keep these simple for illustrative purposes. In this example, let's assume a $200 post-2008 consolidated NOL carry forward. So there's no NOL carry forwards generated in 2017 or prior. In this example, we're looking at the 2021 tax year, and you have a pre-NOL income for that year broken out between your C corporation and your property and casualty company, each company having taxable income of $100. So you add those two together, you have a consolidated taxable income before any NOLs are applied of $200. In this case, the $200 of post-NOL carry forward is applied separately to your two buckets. So for your C corporation, you limit the ability to use that NOL to 80% of your $100. So you have an $80 limitation. For your P&C company, you're allowed to offset up to all of the NOL against taxable income. So you have a NOL absorbed of $100. You add those two together and you get a $180 NOL deduction at the consolidated level. And essentially that leaves you with $20 of taxable income, and that's essentially an effective NOL usage of 90%. So you're able to offset your taxable income in this example by more than the 80% that would be limited if your parent company was just a regular C corporation, and so you get a bit of a better bang for your buck on those NOLs. Example 2 is the exact same facts as example 1, except the taxable income of the C corporation is $100, and the P&C entity has a net operating loss for the year. You add those two together, you get a consolidated income of $50. And in this example, again, you're allowed to offset 80% of the C corporation's taxable income with the NOL carry forward. The P&C company, you can't use any because you're in a net operating loss situation. So again, you add the C corporation NOL absorbed with the P&C, you'd think you'd have $80 of consolidated NOL usage. But what you have to do in this situation is limit that to 80% of your consolidated income. Because the C corporation is the one that has the taxable income this year, you need to apply the 80% of that. So $40 is 80% of your $50 in income. It leaves you with a $10 in taxable income. In the third example, this one assumes that the C corporation has a net operating loss of $50 and the P&C entity has taxable income of $100. So same example, just flipped around. Consolidated income is $50. In this case, because the P&C company has the taxable income, you can offset the full $100 of that NOL in the current year, and that leaves you with zero taxable income. A couple notes in terms of these NOLs. Any pre-2018 NOLs, if they did exist, would be allocated pro rata based on the current year income. So that's important to know if you have prior NOLs generated prior to 2018. Also, the rules address Section 382 limitations, which are your separate return limitation years, known as the Surly limitations. And again, these are very complicated, so just keep in mind that the final regulations spell out how you would address any of those Section 382 limitations. There's also a split waiver election when there's a current member of your consolidated group that was not a member in the consolidated group back in a year that the carryback might relate to. So just keep that in mind, that there's some additional elections and criteria to consider if you have those. All right, so what does that mean? I think some of the considerations that you'll want to look at are your tax sharing agreements. What ends up happening is your insurance company subsidiary might get a standalone audit, or you might produce separate GAAP financial statements for your subsidiaries. And in which case, GAAP requires you to have a separate tax expense. So in a situation where your actual tax filings follow a consolidated structure versus a situation where you're producing standalone financial statements at a property and casualty level, there could be differentiations between the timing and the amounts of any NOLs, for example. So a tax sharing agreement is helpful because that highlights essentially how that separate return or how that separate entity will calculate and share that tax liability amongst the group. And the different rules can essentially complicate separate allocations between when something's accrued and when the timing of any cash flow follows, which could be subject to how management intends for those to be shared between the group. You could follow separate calculations for those taxes, or you could follow what is actually reported in a tax return. And that could be different, and it could be challenging at year end to identify those accruals, not knowing what the consolidated group looks at in total. It comes to tax planning and future M&A activity in terms of the purchase price of any entities that you're considering acquiring. Any NOLs that exist could have a different value today than they did before the CARES Act or the TCJA, so keep that in mind. And your deferred taxes. I think everyone should be revaluing and looking at their deferred tax assets in a different view to see if there is any valuation concerns over those deferred tax assets. So with that, I'll turn it over to Melanie for our first polling question.
Thank you, Matt. Let's take a look at the poll. A net operating loss generated for a fiscal year ending on June 30th, 2021 can be carried back for how many years? A, 2 years, B, 5 years, C, no carryback allowed, D, depends on the type of entity, or E, NA or Johnson Lambert employee. Please make sure that you do press the submit button after you select your answer. As a reminder, answers that are submitted to the Q&A section do not count toward CPE or CRE credits. We will leave you with another couple of seconds to answer the polling question. I will now go ahead and close the poll. Matt, can you talk us through these results?
Yes, absolutely. So this was a little bit of a trick question, just to make sure you were paying attention. So if you recall, these new rules are effective based off of when your tax year begins. And so in this case, in this example, the fiscal year ending in June 30th of 2021 means that the fiscal year or the tax year started in 2020. So with that, the 5 years is actually the right answer here, so that you could carry back an NOL generated for a fiscal year end June 30th, 2021 for 5 years. And that's regardless of what the entity type is, simply because the CARES Act did away with that piece or suspended that piece for the 2-year period. All right, the next item we wanted to talk about was the Paycheck Protection Program, known as the PPP loans. This is essentially a program that was designed to provide a direct incentive to small businesses, in theory, to keep their workers on the payroll and businesses running. It can also be used, for things such as rent and utilities and certain other operating expenses. But the biggest piece here is the salaries that this was supposed to help support. These loans have an interest rate of 1%, so very favorable terms for these loans. So even if you did not seek, forgiveness of these loans, a great advantage to taxpayers should they choose to accept one of these loans. The Small Business Association has a forgiveness if certain employee retention criteria are met and the funds are used for those eligible expenses as outlined. Recently, under Revenue Ruling 2020-27, the IRS addressed essentially some concerns. Again, these loans are essentially forgiven or are considered not taxable, right? So let's say you get a $100,000 loan and it's forgiven. That $100,000 is, in theory, non-taxable, free money to your company. However, what the IRS didn't like was that they thought that if the income is not taxed, that the expenses used with that money should also not be deductible. And so in this revenue ruling, they clarified their position that no deduction for the expenses related to the loan forgiveness are allowed. This is regardless of whether or not the loan is forgiven in 2020 or in a later year. And it's also regardless if the taxpayer has even submitted an application for the forgiveness. Revenue Procedure 2020-51 was issued essentially at the same time, and that provided a safe harbor for claiming these deductions. So if you denied your deductions in your 2020 return, then you have some safe harbor ways of getting that back should the SBA deny forgiveness or you just decide not to seek forgiveness. And those essentially provide for a streamlined way of either amending the prior year return if it was filed already, claiming the deductions incurred in 2020 in your 2021 return when you know that that's not going to be forgiven, or a couple different alternatives. So really what this means is the IRS is taking a harder stance on these expenses and the disallowance of those deductions than what Congress originally intent was. And Congress has made it pretty clear that their original intent was that these funds would be tax-free to the taxpayer and those deductions would still be allowed. So really what's happening is we're expecting some additional legislation between now and sometime in January, along with some additional pandemic relief. It's expected that there's going to be some changes and some maybe clarifications from Congress. But as of now, If you have received a PPP loan and you have any reasonable expectation that that loan will be forgiven, it's best advice to take those expenses and remove those from your tax calculations. The next piece that we wanted to remind everyone of is this employee retention credit. And this is really a credit against employment taxes equal to 50% of qualified wages. And qualified wages are essentially amounts paid between March 12th and the end of 2020. It excludes wages that were used for a credit on paid sick and family leave under the Families First Coronavirus Response Act. So if you've paid wages for someone that was sick or experiencing issues because of COVID, those wages would be ineligible. The credit is a $5,000 limit per employee and per quarter. And it's really when your business is fully or partially suspended by a government order. It's when it applies when gross receipts decrease by greater than 50% of your comparable quarter of the prior year. And the credit would then end in the quarter where gross receipts exceed 80% of the prior year quarter. It's important to note that this credit is not available if you have received a PPP loan, so keep that in mind. The other payroll provision that's worth pointing out relates to the employer deferral of your tax payments, in particular your Social Security taxes. You essentially can defer paying your Social Security taxes on wages paid between, or what would be due between March 27th and the end of 2020. And you can defer these taxes for 2 years, essentially. So 50% of the taxes would be due at the end of 2021, and the other 50% would be due at the end of 2022. The issue that you might have on the tax side for this is the impact on the deductibility of those accruals. So when you accrue those tax payments that will be due for your year end, those deductions will be denied for tax purposes because they do not meet the all events test. They would become deductible in the year that they're paid. So you wouldn't get those deductions, and you would have to record a deferred tax item for those accruals until they are expected to be paid in 2021 and 2022. Another piece of recent legislation that just came out was a revenue procedure that was issued for the loss discounting under 846 of the code for P&C entities. So this is helpful for the 2020 accident year and prior. And so this is welcome timing because everyone's trying to finish their year-end provisions or gearing up for it. And so these factors are helpful in terms of not having to wait to close your books and estimate these factors. The RevProc has an interest rate that they applied of 3.08%. And this is compared to a 3.07% in 2019 and 2.94% in 2018 for comparative purposes. So the interest rate isn't fluctuating a whole lot, which makes sense in an environment that we've been in the last few years. As a resource in our resource center, you will find a link in our blog post that we have about this, and that includes a table that summarizes the discount factors for all the years at hand. A few other miscellaneous items as a result of the CARES Act. As part of the CARES Act, they fixed a technical issue in what they determined the qualified improvement property. This correction was warranted because it allowed for a 15-year life for certain improvements to your essentially your internal improvements of non-residential real property. It does exclude structural changes and additions, and specifically elevators are not eligible for that. But any addition that you make to your office buildings can qualify in most cases for a 15-year life. And what's important about that is that makes it eligible for bonus depreciation. So you can get essentially 100% deduction in the year that improvement is done. You can either amend a prior filing if that was not taken, or you can file a method change to retroactively bring that change in. Alternative minimum taxes, the TCJA was great at removing the alternative minimum tax for corporations. But what that will do is cause some additional complications now under the CARES Act with the ability to carry NOLs back to years where the alternative minimum tax rules still apply. So you'll have to go through some calculations to develop that. But at the end of the day, this should have very little impact in terms of a current receivable perspective because those credits are essentially fully refundable as part of the CARES Act. So whereas under the TCJA, any prior year AMT credits that were carried forward could be either used or you could use 50% of it as a refundable credit through 2021. So that those provisions are no longer gone. They're gone under the CARES Act, and essentially any AMT credits that exist are fully refundable if you cannot use them. A couple other changes: the interest expense limitation. There's an increase to the limitation for 2019 and 20, and that goes from 30% to 50%. Same thing with charitable contributions. You're allowed an increased limitation of 25% for qualified contributions through the end of 2020. With that, we'll look a little bit forward thinking in terms of what some of the tax policy that might happen. I know Congress just today is closing in on a $1.4 trillion package to keep the government open. And as part of that package, it's expected that there's going to be some additional relief related to the PPP-related expenses. There's also likely going to be other tax provisions encompassed in any package that gets passed. So we're all keeping our eyes open and ears open to see what those pieces are that Congress is thinking about, considering at this time. The IRS guidance, a priority guidance plan, they issued that, and they are on a fiscal year. And when they issued that, there was 191 items on their plate. So think about the TCJA and the largest tax reform that was done since the 1980s. They had a lot of guidance items that needed to be addressed as part of that. And of the 191 items, the IRS has issued guidance on roughly 57 of those, as of end of September this year. So there's a lot of activity that the IRS still has to do in the coming months. The Senate runoff elections, I think that's important to highlight here too. The two open seats in Georgia, could drastically change the determination of power in the U.S. Senate, and this could really impact the ability of a Biden administration to pass any tax policy. It could also make it very difficult to plan ahead. Right? Taxpayers have to, the clock stops at the end of the year. So December 31st rolls around, the clock stops. You can't go and do retroactive transactions, back, in January back to the end of the year. And so the outcome, of the Senate runoff in Georgia is essentially expected in the early part of January. So that provides some complications in terms of tax planning. In terms of the Biden tax proposal, his proposal suggests an increase in corporate rate to 28%. So that's from a 21% to a 28% could have a drastic impact to companies. And if that happens, you've got, again, tax rate differentials that could impact your carry forwards and your carrybacks. And it's certainly something to consider in the planning phase. His proposal also establishes a minimum tax on book income, which would be the minimum of your normal tax, or 15% of book income if your book income exceeds $100 million. He's also suggesting an increase to the Social Security tax if your income exceeds $400,000, and that would be an increase to the employee and the employer. He's suggesting an increase to the highest individual tax bracket. So as part of the TCJA, the individual's highest tax bracket was reduced to 37%. Under the Biden's proposal, he's suggesting that go back up to 39.6%, which is consistent with with prior to the TCJA. The proposal also suggests an increase to capital gains tax, which would essentially be taxed at ordinary rates for anyone that has taxable income in excess of $1 million. So I don't think that this is going to impact a lot of people, but if you have taxable income in excess of $1 million and a significant portion of that is related to capital gains, just keep that in mind. That could be a significant rate increase where you have capital gains tax at very favorable rates now, up to 39.6% could have a drastic impact. So there's a lot to consider there, and I think year-end planning considerations. I think you really need to go into the end of the year with the information that's at hand, what you're aware of, and what you expect might happen in the future. That could impact your deferred items, could impact your current. So just keep that in mind as you go into the year and monitor guidance as it's published.
Thank you, Matt. That was a great summary of tax legislation and upcoming considerations. We now have our second polling question. What tax legislation do you believe provides the most benefit to your organization? The Tax Cuts and Jobs Act, the Coronavirus Aid, Relief, and Economic Security Act, both, Congress is getting it right, neither, tax legislation baked by Headspin, or NA or Johnson Lambert employee. I'll give you a few moments to decide. Again, please make sure you click submit when you have selected your final answer. I will now close the poll. And it looks like we've got a variety of responses here. Matt, what are your thoughts on the results?
This is actually consistent with what I was expecting. I think most corporations felt that the reduction in the tax rate was significant, which it was. So I think that makes sense from that perspective. And I do think that, personally, Congress is trying their best to get it right. And so I do think with the Coronavirus Act or the CARES Act, they really tried to provide a stimulus for companies that might be struggling. Whether or not it's all getting to the right hands, is probably a different discussion. But I think that this is consistent with what I was expecting.
Great. Thank you, Matt, for sharing your thoughts and providing us with that tax update. Now let's switch gears a little bit to the accounting side. Josh, 2020 has been an interesting year, to say the least. Can you talk us through some considerations and action items that are relevant to companies in the current economic environment, especially as we head into year-end financial reporting season?
Yes, thanks, Melanie. Definitely. I thought it would be helpful just to start off the conversation with some thoughts around disclosures and specifically thinking about where we were 2019 financial reporting wrapping up, in that March timeframe, and COVID really being a subsequent event disclosure. Now in 2020, living through it, obviously we need to think about the real impacts as well as some of the potential impacts as it relates to uncertainties. And so I think a highlight here is just making sure disclosure in 2020 is robust and represents what is actually going on inside the organization. Known events. We're going to talk about some accounting estimates, potential impairments in a few minutes here, thinking about what to say in the disclosures related to those. Then also, I guess, thinking about just the general uncertainty. Luckily, we've heard recently that the vaccines are starting to go into production and actually being put into use now. But we still have a lot of uncertainty and probably a fairly long runway before this pandemic is in the rearview mirror completely. And so a general disclosure around the uncertainty, especially when you think about the impacts to companies, the vendors, potentially employees, policyholders, and the investment markets that are continuing to surprise me and everyone around us sometimes in the behaviors in the markets. So thinking about that in your disclosure, but also in the actual accounting during 2020 and reflective of the events. I think the other part to remind management to think about too is the changes in internal controls and the potential misstatements flowing through the financial statement reporting process. In the remote work environment, a lot of things had to change fairly quickly. We've had some time to digest those changes, but thinking about the documentation trail and management's ability to look back at documentation to make sure that those control changes actually went into place in a way that made sense, but also that they were operating effectively. And I think the thing to think about there is, the auditors coming in at year end are probably going to think about COVID-19 as it impacts to the organization operationally as well as financially, are likely to drive a significant audit risk into the external audit process. So I think we'd be remiss without reminding folks to continue to think about the risk environment and managing risk in a changing world. The fraud triangle is nothing new, but the incentives, opportunities, and rationalization of fraud potentially is heightened this year. thinking about the organization themselves, maybe not having direct financial impact. What we've heard, most organizations have weathered the storm fairly well, but you never know what's going on in the employee's home situation or your vendor situations, where they may be incentivized or motivated to dip into the coffers or do other things that are inappropriate, and rationalizing those given where we are in needing to meet budgets or otherwise. So I would just make sure that management is continuing to think about fraud risk as it relates to this financial reporting cycle. I think some takeaways for organizations to implement and make sure that are continuing to be followed and administered. Risk assessments, looking backwards as to what changed as we went into this remote environment, but also looking into the future and what's coming down the foreseeable pipeline of events, or just the economic uncertainty as it continues to unravel. Strong culture of internal controls, and that tone at the top in a remote environment is difficult, but making sure that we haven't lost anything along the way by having to do Zoom calls rather than being able to have that town hall meeting inside the four walls of your building. Talked about it before, there's internal control designs, but thinking about segregation of duties, different work structures for folks and needs at home to balance the work and the life of potentially having to deal with at-home students or otherwise, maybe having different people doing different responsibilities during the day to keep the lights on and things moving through the organization. So just think about segregation of the duties and where some of those opportunities have come through, but also really on those controls, are they operating as they were designed? And those control frequencies related to those judgments and estimates, I think those are going to be something we'll highlight here in a minute, but control around those judgments and estimates and using the best information available to paint the best picture in your financial statements related to the estimates you need to make. Talked about vendor management, but thinking about the impacts of the environment outside your four walls and reliance on others, and do we have situations that are still unraveling as it relates to the economic uncertainty impacting our key vendors. And I think everybody's disaster and recovery and business continuity plans got put to the test, and so learning from that fire drill and making sure we've got action items to get in front of it in case it does continue, or we've got the next wave coming our way. As I mentioned, fraud risk is not going away, so stay vigilant. So shifting gears now more toward the accounting side rather than the controls, thinking about accounting estimates and really what's going to be front and center as we head to this December 31st financial reporting. In the GAAP world, looking at allowances for doubtful collections generally is going to be based on historical trends and patterns, but this is a different year. We've had changes by regulations on potentially, or even just by the company themselves, deferring billing to policyholders as a relief mechanism, and those trends in aging may not necessarily be indicative of the historical patterns. And so really putting that in front of management to make sure that you are updating your assumptions and understanding and really looking at do we have impairment to recognize related to premiums or other receivables. We talk about impairment other than temporary impairment for fixed income and debt securities. Luckily, if we're holding a maturity portfolio where we've got some longer term bonds that we haven't recently purchased, we were in a higher interest rate back then than we are today. And so we've got generally unrealized gains coming through as the interest rates have continued to decline throughout this year. But there also is the need to continue to evaluate for credit impairment. And so do we have bond issuers that potentially have credit events, or are we dealing with some structured securities where patterns related to mortgagees or otherwise collateral-based in securities that need to be updated for potential changes in the patterns there? So that would drive the updated contractual cash flow projections. Ability to hold and intent is also necessary. We think about those bond securities, so looking at your financial condition as well. Luckily, as we think about the equity security worlds, 2019 was the first year private companies had to implement the ASU 2016-01, which basically requires all equity securities changes in fair values to flow through net income. And so luckily we don't have to do OTTI analysis on those unrealized losses on equity securities where the change in fair value is going through the operating statement already. So that's a nice relief, but then there is the alternative model available under that ASU 2016-01 for equity investments that don't have a readily determinable fair value. there's an option to treat those basically under the alternative model, which is cost less impairment plus or minus changes in observable prices. And so there is still that need to look at those for potential impairment as it relates to those non-readily determinable fair value equity investments. Mortgage loans, we know the real estate world has definitely changed, and a lot of organizations are reevaluating their real estate plans, and the leases that back up those mortgage loans may have some developing situations, and so looking at potential impairment related to mortgage loans, especially if you're a direct investor in real estate as well, those leases are generally the cash flow that's going to pay back the ability to make good on those investments. And I'd also be remiss by not reminding folks to think about the impact of the economic uncertainty and the operations on potential impairments for any goodwill, if you're carrying any goodwill from prior business combinations or intangible assets or other long-term assets. Just that impairment model is something to make sure you are walking yourselves through at year end. Troubled debt restructuring, luckily we got some relief from the FASB for any adjustments to borrowers that were in a good condition prior to the onset of the pandemic, and any minor concessions to those borrowers and payment terms or otherwise are not going to be considered to be troubled debt restructuring. But if there are more than minor concessions made, there is a potential trigger of needing to evaluate that. So just plant that bug in everybody's ear as well to remember that. And then as Matt indicated, just the uncertainty around the tax landscape, but also the economic uncertainty in supporting need or lack thereof of a valuation allowance for your deferred tax assets is going to be complicated by the changes in the tax rules, but also still highly dependent on sometimes forecasting taxable income to support your ability to realize those. So a lot of moving pieces in the in the estimates world, and just want to take this time to highlight those for folks.
Thank you for sharing some of those risks and impacts with us, Josh. I think these are particularly relevant as companies near their year-end close. Now let's go ahead and take a look at our next polling question. Which of the following assets do not require an analysis of impairment for GAAP? Premiums receivable, fixed income securities, common stocks with readily determinable fair values, all of the above, or NA or Johnson Lambert employee. Again, I'll give you a few seconds to make a selection and then close the poll. Great. It looks like most of you got the correct answer, that being C, common stocks with readily determinable fair value. This is correct, as only those equity securities without a readily determinable fair value would require an impairment analysis. So now we are ready to dive into some upcoming GAAP accounting changes. Fortunately, companies have received some relief when it comes to the timeline of implementing some of the more significant upcoming standards with the deferral of the implementation of leases and credit losses. 2020 is also a fairly quiet year when it comes to new pronouncements, but I know we do have a few considerations as it relates to cloud computing and the LIBOR. So Josh, can you talk us through these upcoming standards?
Yeah, I'd be happy to, Melanie. Thanks for the introduction here. Before we can take a look at the new guidance on cloud computing arrangements, or CCAs, we do need to look back at the initial ASU that was issued back in 2015. So turn back the clock to ASU 2015-05, and we'll see that it allowed capitalization of cloud computing arrangements as internal use software or intangibles if the hosting arrangements contained a license. And it went on to really define what that meant by saying it contains a license if the customer has the right to take possession of the software at any time during the hosting period. And it's feasible for them to run that software either on their own hardware or by moving to another party, a hosted party. And if you meet these requirements, you can capitalize as an intangible under ASC 350-40, and we'll talk about that in a little bit. But if not, it would be counted as a service contract. And the problem here is that the service contract guidance, it didn't really have a a lot of guidance in place for this. So some companies were treating this as a prepaid asset and only amortizing it when it got placed into service. Others were amortizing it over that whole hosting period. Others were really expensing it as paid or incurred. So the new ASU looks to clarify that. And we have seen in practice some differences as well here around the implementation of 2015-05 and when it's appropriate to capitalize and when it's not. We've seen some companies look to implement customized systems in a general cloud environment like Amazon Web Service. So they may hire a consultant to build out a program or take their existing application and move it to the cloud using something like AWS. But then there's other packages that really don't meet the definition of a license here, where the prepackaged system of modules, maybe something like a Guidewire or Sapien, that are commercial lines carriers typically use. And those can be fairly easy to determine what bucket you're in. There's other vendors like Salesforce where it's fairly customizable, but you're using prepackaged systems, and it can get a little confusing as well. So definitely an item that if you're looking to implement a new system, to try to make sure you're aware of what bucket you're falling into before you implement. So let's look at the new guidance on service contracts. If you didn't have a license in your contract in your hosting environment, you fall into this new guidance. It is effective for periods beginning after December 15th, 2019. And looking at these CCA service contracts implementation, you're allowed to capitalize the implementation costs for hosting arrangements that are service contracts. So if they don't have that license, if you fall within the application development stage, you're allowed to capitalize them, and that's consistent with ASC 350-40, and there's some guidance around what application development stage expenses qualify for capitalization. If it's preliminary or post-implementation stage costs, you're required to expense those immediately, so that's very clear now. There's also new amortization guidance where you amortize over the term of the hosting arrangement, beginning when the hosting arrangement is ready for its intended use, or the software is ready for its intended use, through the non-cancelable period of the arrangement, plus the options that you see here. So if you have a monthly type service contract, you wouldn't start expensing those until the software is placed into use and ready to be used. At the end of the day here, when we look forward, it ends up being kind of a hybrid approach in that it looks back to ASC 350 on what you're allowed to capitalize, but then requires that to be presented and disclosed more like it's a prepaid expense. So as you see here, it's not considered a long-lived asset. You would capitalize it on the balance sheet, but it's required to be in the same line item that the prepayment fees associated with the hosting arrangement is included. On the income statement side, it's required to be expensed in the same line item as the hosting element fees as well. And the amortization expense relative to the service component cannot be presented with other amortization for property, plant, and equipment, and other intangibles. And then the cash flow follows that same logic as well. So moving on, the other disclosures that are required for CCAs, if you capitalize those service contract costs, are very similar to other types of intangibles or property, plant, and equipment. Follows that same ASC 360-10 guidance. So you've got the gross amounts as well as the accumulated amortization that's required to be disclosed. It does treat the service contract implementation costs as a separate major component of those depreciable assets. Transition model here, you have two available methods. You can either do it prospectively just to the initial year of adoption, or you can do retrospectively and go back in time and adopt back in time as well. So with that, we'll turn it over to Josh Keene, who's going to talk a little bit about LIBOR and the reference rate reform.
Thanks, Josh. Yeah, just another quick reminder before we shift gears to the auditing standards and remaining GAAP updates. LIBOR is going away, so that is the London Interbank rate that is going to stop being published at the end of December 2021. And so many contracts are out there reflect that as part of a variable interest rate, promissory notes, surplus notes, lines of credit, premium financing or loans, and derivative contracts. And so with that going away, there's going to be a lot of legal work that needs to happen. Those contracts are not going to have a legal thing to point to anymore. And so the legal team needs to go update those with the parties to the contract to make sure we have a new reference rate. Normally that would change or reflect as basically a change in the contract, and GAAP would have said we need to reevaluate that as a replacement contract from an old one. The FASB gave us some relief this year and said basically upon issuance of this ASU, you can treat those new agreements and the modifications to those as not requiring remeasurement. I'm just treating them as a go-forward amendment. So I think the takeaway here is get the legal team working on getting those LIBOR rates out of your contracts, make sure you have the inventory of all those contracts that do refer to LIBOR on the table to go through that process and get that moving forward. And luckily the accounting is going to be fairly easy on that one. So next we're going to shift to what is the GAAP changes that are on the horizon. And as Melanie indicated, we've gotten some relief from the FASB. So we're going to spend a couple seconds here talking about what's coming down the road. So 2021, we've got a change related to the disclosures for defined benefit plan sponsors in their financial reporting. It eliminates and clarifies some of those disclosure requirements. So this is a relief. So that's one that's coming into effect in 2021. Leases and credit losses have been around for a long time, and it just feels like they're never going to get here. But leases is for non-public business entities. And I guess I should qualify that this is all the non-publicly public entity disclosure requirements and changes in the accounting guidance. Leases do not go into effect until 2022, and credit losses is coming into effect in 2023 now. So a couple more years to work on those, making sure, get ahead of the curve because they are not easy to implement sometimes. And Johnson Lambert will be working on white papers to help assist clients and colleagues to help work their way through implementation of those key standards. And then the last one here is the targeted improvements to long duration insurance contracts. So this is the life companies generally. That now has gotten pushed out to 2025. And so definitely a longer runway on that one. And again, that came out in part of the relief from the coronavirus and the strains on organizations as they went to implement some of these very, very complex accounting standards.
Great. Thanks to both Joshes for that update on the accounting side. There are also some significant upcoming changes to the auditing standards. These standards will modify the form and content of the auditor's report and introduce key audit matters, a similar concept to the PCAOB standards, critical audit matters. Josh P., can you talk us through what organizations need to know to be prepared?
Sure. Thank you, Melanie. The Audit Standards Board and the AICPA has been working on this for some time now. It's actually started back in 2015 or 2016 when I was on the Audit Standards Board. And really the intent here is to bring generally accepted audit standards in line with the PCAOB standards as well as the international standards issued by the IAASB. It does modify the content of the report, as Melanie mentioned. Also introduces the concept of key audit matters. Again, here it's similar to PCAOB standards, but it's one area where the ASB elected to go more in line with the international standards. So there are some key differences here. Mainly that it is optional, so companies will get to decide whether or not they engage their auditors to do this. So we wanted to get in front of this and let companies know so you can make an informed decision. It will impact audit reports, all audit reports, because it's an audit standard. So if you're statutory basis, GAAP basis, even governmental accounting basis entities will be impacted by this. And Johnson Lambert is adopting this for calendar year end 2021 entities. That's consistent with the majority of large national firms. It can be early adopted by firms, so you may see some auditors out there with audit reports that look a little different for their calendar year end 2020 entities as well. This is a fairly significant suite of standards. There's actually 7 audit standards listed here that are impacted. Today, we're going to focus more on the standard report under GAAP. However, all of the other types of reports would be impacted as well. So if you've got SOC reports, those types of other items falling under some of these other standards, those are also going to be changing. So let's take a look at what changed. I think the biggest thing is just it's more of a plain English user format. So you'll see that. But then also the sequence of the report is now being mandated or required by the audit standards. In the past, there was specific items that were required. However, the sequence of items could be moved around by the auditor. So some firms put the opinion first. Most firms in the past had the opinion last. Now all of us will be required to have our opinion or conclusion paragraph first. So let's take a quick look at that. The next couple of slides are a little hard to read. Definitely encourage you to download our white paper on this from the Resource Center and follow along. You'll see in here we've tried to highlight areas where there are new concepts being introduced to the audit report in that mustard-colored text. So again, here you'll see the audit opinions first. Under the basis for opinion, there's now new wording around independence and ethical requirements, just alerting the user to those items. There's also new wording in the responsibility of management section on their responsibility for going concern analysis. Continuing on, the most significant area impacted is the auditor's responsibility area. Several new concepts for the audit report that aren't new to anybody that's been operating in this area. So things like materiality, reasonable assurance. Not new concepts, but new terminology for the audit report. So you'll want to read through those and just get an idea of what auditors have been doing as part of the report. The new concept here, key audit matters, again, we call this CAMS. It's matters that the auditor's professional judgment were most significant to the audit of the financial statements in the current period. Again, CAMs are optional for non-public entities. It'll be management, those charged with governance, that decides whether or not to engage us, and then the auditor will decide how to report those. At this point, we haven't seen any regulators introduce requirements to include CAMs. That's definitely a possibility. I think when this was being initially debated, the Audit Standards Board thought maybe this could come into play for publicly accountable entities, such as large nonprofits, maybe banks. I think if we see the banking regulators start to require this for non-public banks, it could be something that insurance regulators start to look at as well. But at this point in time, we haven't seen that yet. So we'll move forward to what are CAMs and how will they be reported? And again, based upon that definition, it will include things like significant estimates and areas that required significant interpretation, maybe interpretation of new guidance, and then also significant operating events as well. So things like new IT systems could impact the financial reporting, and they could be something that would be reported on by the auditor as part of the reporting on key audit matters. And this is an area that's a little different than what the PCAOB's CAMs or critical audit matters would include. You see the definition for critical audit matters here under the PCAOB side really more focuses on accounts and disclosures that are material to the financial statements, so it feed in on that. So things like operational risk, like that IT change, likely wouldn't be recorded under critical audit matters under the PCAOB, but could under the AICPA. So for private entities that are a member or a subsidiary of a public parent, think about that a little bit. So it's not going to be like by adopting the key audit matters or requiring your auditor to report on them, that won't necessarily flow up appropriately into the consolidated financial statements. So in deciding whether to report on CAMs or not, again, we're not aware of any insurance regulators at this point that will require them, so keep that in mind. I think there's other ways that organizations can communicate these items as well. So things like management discussion and analysis really give you more freedom to report on the items critical in management's opinion. And then CAMs could also become public in terms of disclosure, so companies should think about that and whether or not they want those types of items to be publicly available. And then the final item here is probably the most important, is just the cost and benefit of doing that cost-benefit analysis around whether that additional information really provides value to the company or not. And I think a lot of that will be market-driven for insurance entities rather than regulatory, driven by the regulators at this point. So, Melanie, that wraps up this section. Do you want to take us on to the next polling question, final polling question?
Yes, I'd be happy to. You should now all see our final polling question, which is, does your organization plan to include key audit matters in your audit report? Yes, no, unsure, we need to complete a cost-benefit analysis, or NA or Johnson Lambert employee. I'll go ahead and give you a few seconds to respond and then close the poll. Okay, I'm going to go ahead and close the poll in a few seconds here. Okay, looks like most of you are unsure and wanting to complete that cost-benefit analysis. That makes sense given where most organizations are probably at with thinking ahead to this standard. We do have some questions in the queue, but as we're going slightly over our time today, we will go ahead and respond to those questions via email in the next couple of days. Before we end here today, I do want to invite you to join us for our insurance industry statutory accounting and tax update on January 12th. And if you're not receiving our webinar invites and alerts, please make sure to subscribe on our website. And as always, we are available to you. Please contact us at any time with your questions. You can email any of today's presenters, or you can submit our questions directly on our website. I would like to also remind you to download your CPE or CRE certificates before you leave the platform today. And lastly, I just want to thank you all again for joining us here this afternoon, and we hope you, your loved ones, and your coworkers have a happy and healthy holiday season. Thank you.